Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome, everyone, to the Go Ahead Ask podcast by the Exeter Group. Our job is to unravel the mysteries of real estate, and our goal is to provide you as investors with quality education to help you make better informed real estate investment decisions. We're going to have a lot of exciting topics coming up, including things like exit strategies for highly appreciated real estate, net lease properties, a specific podcast on 2 to 4 unit rental properties, qualified opportunity zone investments, Delaware statutory trusts, or really fractional ownership of real estate. We're going to have a CPA talk about real estate tax issues. And then we'll get into some nitty-gritty topics like seller carryback notes and how they work with 1031 exchanges. We really want to encourage questions. So if you have questions either before or during our podcasts, send us an email at ask@exeterco.com. That's ask@exeterco.com. And we'll address those questions on the next podcast. So we do want to encourage questions. That's what we're all about. That's why we call it Go Ahead Ask. First, with the introductions, my name is Bill Exeter. I'm one of your co-hosts.
I'm Hiba Exeter.
I'm Lauren Speidel.
And I'm Mark Turok.
And the four of us are your hosts for Go Ahead Ask. Today's topic is Unraveling the Mystery of 1031 Exchanges, Part 1. What we've found is a lot of people have asked 3 or 4 people, got 3 or 4 different answers. They're totally confused. So we're going to help unravel the mysteries of 1031 exchanges. And that's really why we called it Unraveling the Mysteries. There's just a lot of confusion out there. The codes, the regulations, the rulings sometimes don't answer the question completely. Sometimes it creates other questions. A lot of times when you call 3 or 4 people and you get 3 or 4 different answers, what you're really getting is 3 or 4 opinions, but it sounds like fact. And so our job today is to unravel the mysteries, to kind of go through the more important parts or requirements of a 1031 exchange and point out why there's confusion and really what the pros and cons are and the aggressive and the conservative positions. And then you as the investor can make a better informed investment decision.
For those who haven't worked with us before, we are an exchange accommodation title holders. We administer all types of 1031 exchanges. We cover all 50 states, and we even do foreign exchanges as well. The types of exchanges that we provide are forward, reverse, improvement, zero equity, real property, and foreign properties as well. Exeter 1031 exchanges had administered exchanges for over 15 years. Personally, Bill Exeter himself has administered over, I think, 125,000 1031 exchanges throughout his 35-year careers. We are considered more consultative and advisory services, and we are available 24/7.
That explains kind of my lack of hair up here.
That's so true.
And for those who have worked with us before, we've had an addition to the family. So we recognize that one of the important things is to have government oversight. Qualified intermediaries hold a lot of money for a lot of clients. So we spent a couple of years, actually more than a couple of years, kind of going through the regulatory review and approval process. And we got our trust company charter a couple of years ago. So Exeter Trust Company is now licensed, regulated, and audited by the Wyoming Division of Banking. And we'll talk more about what that means later. But the key thing, too, is we're able now to roll out other products. So that includes self-directed IRAs, custody services, title holding trust or land trust, as well as specialty holding escrows.
Section 1031 is a code within the IRS. It allows you to take property that you've held for rental income, appreciation, or use in a trade or business, sell that asset, and have your full net sales price working for you in another asset, again, used for rental income, appreciation, or use in a trade or business. And really, 1031 exchanges have been around for hundreds of years. Before it was actually a code within the IRS, you'd have farmers barter for livestock, they barter for land, until it actually became a code in 1921. And from there, I'll let Bill discuss the history of the exchange.
You know, it's interesting you mentioned that too. It just dawned on me. Next year is 2021, and 2021 is the 100th year or 100th anniversary of 1031 exchanges. They date back to 1921, so that's amazing, 100 years. I would have never thought I'd be sitting here saying I've been doing this for 36 years almost. But so it dates back to 1921. So quick history of the 1031 exchange. Years ago in the early 1960s, and before that, all the exchanges were done concurrently. In the early 60s, there was a family up in the Pacific Northwest in Oregon and Washington by the name of Starker. And the Starker family owned a whole bunch of timberland, and they ended up selling that to Crown Zellerbach Corporation in return for a promise that over the next 5 years, they would identify property they wanted. Crown Zellerbach would buy it and deed the property to the Starker family. So it was really a 5-year delayed exchange. And of course, they got audited, the IRS disqualified that, and they took it all the way to tax court. And the Starker family won almost every single point in a number of different cases. So they set the precedent for what we have today as the delayed exchange we have. I will talk more about deadlines and everything later. So if you hear somebody refer to it as the Starker exchange, that's why. It's after the Starker family who really fought that whole process. Don't want to get into too much detail on the Tax Reform Act of 2017, but the one thing that came out of that is 1031 exchanges only apply to real estate. So personal property, which was non-real estate, which means exchanges of aircraft, shipping, trucking, machinery, equipment, etc., no longer qualify. So now only real property qualifies for 1031 exchange treatment.
Other reasons why you would want to do a 1031 exchange, you want to diversify your portfolio. You can even consolidate your portfolio and have less management or even no management. Ultimately, you're looking at repositioning your real estate portfolio to make something that works, make the money work for you, make the investors' wealth work for them, because the tax consequences can be quite prohibitive. And ultimately, looking at some of the benefits, the gain can be deferred off into the future. And as long as you keep exchanging off into the future, you can defer that gain up into the point where you pass away. And then eventually, there is no tax implications or consequences for the investor. But again, it just keeps the money working for that investor.
And it really gives the taxpayer, the investor, a chance to reposition their portfolios. So, today we're going through COVID-19. A lot of people are thinking, oh, what's going to happen? Retail is going to get hit hard. Commercial office will probably get hit hard. Things like that. So people may want to sell those assets and exchange into property that may do better under COVID-19. So it's you certainly take advantage of repositioning, diversification, consolidation, whatever that means.
And just going off of what Mark mentioned in regards to the biggest benefit of the exchange is really the estate planning benefit of the 1031 exchange. When you do a 1031 exchange, it can be a wonderful estate planning tool because as you build your portfolio, you're again deferring that tax. You're keeping the wealth in your family, and unfortunately, there's a term within our industry called swap till you drop, because eventually, you've built your portfolio through real estate. Hopefully your portfolio is much larger at that time, and when you pass, your beneficiaries receive a step up in cost basis. So that ultimately means that the beneficiaries would hire an appraiser to come out, take a value of that property at the date of death, and then if they sell it shortly thereafter, they are not going to see any tax liability from that sale. So, they always say the way to escape taxes is to pass away, and ultimately that really is the biggest benefit of the 1031 exchange.
The good news is the estate plan is to die. The bad news is the estate plan is to die.
Exactly. And there are a number of 1031 exchange structures. Earlier in the podcast, Hiba mentioned a number of different 1031 exchanges. There's the forward exchange, which is really the most common. I would say that makes up most of our transactions. And that is when you are selling one property and you are purchasing one replacement. There is also a simultaneous or concurrent exchange. And just like Bill mentioned earlier, up until the TJ Starker case, you really saw concurrent and simultaneous exchanges happen all at the same table, the closing table, within minutes of one another. So you'd sell one relinquished property and you'd be buying one replacement. But there are also some more complicated structures. We've do many reverse 1031 exchanges. With a reverse 1031 exchange, you are actually buying the replacement property first, and then you are selling your current asset. In this situation, it involves a parking arrangement through Exeter Exchange Accommodation Title Holder Services. So we would actually create an LLC. We would be member of that LLC, and we would purchase that replacement property on your behalf and park title to it, because you can't own both properties at the same time. We also do improvement or build to suit construction exchanges. With that type of structure, we are going to purchase the replacement property on the taxpayer's behalf. And then their goal is to use as much of their exchange proceeds as possible and to construct as much as possible within your 180-day time period. So timing for exchanges, of course, are critical. And these are really the most common exchange structures that we handle.
And certainly the reverse exchanges help eliminate a lot of the risk of doing a 1031 exchange. I mean, today, in today's market, you've got multiple offers, bidding wars. We got to deal with COVID-19. There's just a lot of obstacles out there, where the reverse exchange lets you go out, spend all the time you want to really find the right property, do your due diligence, and then close on it first, so you know you've got it. Downside, of course, they're more complicated and there's more costs involved.
To add to Lauren, you will need a 1031 exchange involved prior to closing on your replacement or your relinquished property. What we do is we prepare the legal documents that are related to the transaction. We receive and we hold the safeguard 1031 exchange funds into a separate qualified trust accounts. And that's what makes us unique than other exchange companies, is that we have them in a separate account.
And to kind of add to that too, a lot of people don't talk about how to choose a qualified intermediary, what's important about the qualified intermediary. So that's something we want to address here, because that's critical. Qualified intermediaries administer a lot of 1031 exchanges. They hold a lot of money for the clients. And so how do you protect yourself in choosing the right qualified intermediary and making sure your funds are protected? So Hiba's right on the money that the separate segregated qualified trust account is critical, and I'll expand on that in a minute. I think the most important thing that we want to look for when choosing a qualified intermediary is whether there's any government oversight. Is somebody watching and auditing and reviewing the operation and making sure they're operating in a safe and sound manner? Very few qualified intermediaries have any kind of government oversight. That's because in our industry, there is no licensing requirement, or there is no regulatory body that overlooks us. So that's why we chose a number of years ago, as I mentioned at the very beginning, to go through the regulatory review process and get approved as a trust company, because now we are licensed, regulated, and audited by the Wyoming Division of Banking. And we're subject to an annual audit every year, where they come in and audit all of our processes and our procedures and all the transactions to make sure that we're operating in a safe and sound manner. So I think number one is to make sure that the qualified intermediary you're working with has some kind of government oversight. In our case, we're licensed as a bank under the trust guidelines. So I think that's the number one issue there. Less than 1% of qualified intermediaries actually have any kind of licensing, regulatory, or review or audit process. After that, you want to look at the insurance and bonding, absolutely, for sure. We're all human, there's things will happen. So you want fidelity bond coverage. Fidelity bond covers crime insurance, so misappropriation of funds, theft of funds, embezzlement, etc. You want errors and omissions insurance. E&O insurance covers you in case the qualified intermediary creates an error. or maybe omit something and that creates a loss for you. So you want to make sure that there's insurance in place to cover that. And then finally, what Hiba mentioned was the qualified trust account. And you need to make sure that your funds are held as fiduciary or client funds, not corporate funds. So by having the funds held in a qualified trust account, they are clearly, number one, subject to government oversight in our case, but number two, they're clearly held as client or fiduciary funds. So if something happens to us, your funds are still held as client funds and not considered corporate funds. So that's critical. In our case, too, we've taken it a step further, of course, with the trust company charter. So now they're separate, segregated, dual signature qualified trust accounts. So they're completely separate. Each of you get your own 1031 exchange qualified trust account, but it also requires 2 signatures from Exeter and at least 1 signature from the client to disperse any funds. So you have control over when the funds are dispersed, and that's really critical. At this point, let's jump into the requirements of structuring a 1031 exchange, what counts, what doesn't count, etc. Qualified use is probably the most critical issue in the 1031 exchange process. So qualified use means that the properties you're selling, your relinquished properties, and the properties you acquire, your replacement properties, through the 1031 exchange process have to be held for some type of rental, which means income production, cash flow, or some type of investment. So it doesn't have to produce cash flow. It could be held for capital appreciation. Some people buy land or buy a condo and just hold it until it goes up in value. They don't rent it out. Or you could buy something that you use in your business or in a trade. And as long as it falls into one of those 3 categories, it qualifies for qualified use and 1031 exchange treatment. But those categories get really confusing, and that's where we wanted to kind of dig deep. This is probably the area that has the most confusion out there. It's probably the area where you get the most opinions that sound like fact, and it gets really confusing. So let's dive a little deeper here. It all boils down to what your intent is. If you intend to buy and hold the property for rental, investment, or business use, it qualifies. If your intent is to buy and hold the property for sale, it doesn't qualify because it's really inventory in your real estate business. So examples of that would be someone who buys the property with the intent to fix it up or rehab it. People call them flippers or rehabbers. You really buy, you rehab, and then you sell. You're holding the property for sale. You're not holding it for investment purposes. You might be a developer, contractor, builder. You typically buy, you build, you sell, and you're holding for sale. Now, in those examples, if you were to buy and rehab or buy and build and then hold as investment or rental property, it would qualify for 1031 exchange treatment. A third example would be condo conversions. You buy an apartment complex, you convert to condos, and you sell. You're holding for sale. It doesn't qualify. If you were to buy and convert and hold as rental properties, it would qualify. So it's not all of the other things you hear out there that may or may not qualify. It's the intent that's critical. If you get audited, can you prove that you had the intent to hold the property for rental, investment, or business use?
You know, and really looking at the holding period, I get this question a lot. People call in or I'm out and about and they'll ask me straight up, like, how long do I have to hold on to my property? You know, all through the process and at post, before. And I'll tell them, you know, honestly, there is no requirement in the code that says you have to hold it for X number of months, years, whatever. A lot of advisors will say a year and a day, 18 months, 24 months, 24 months, 2 years. That's fantastic. But honestly, it's like what Bill said, the most critical component there is the intent. Do they hold it for rental? Do they hold it for investment purposes or for business use? And that, along with the duration of time, there you go. That's the main critical component. But it's not, the timeline is not, the most specific of 1 year and 2 years. It's really the clear intent of the investor.
There's 2 examples where they're both developers, they're unrelated, they're tax court cases. And in both cases, the individuals or companies bought the property, bought dirt, intended to build single family homes and sell it. In both cases, neither one built anything. So both bought the dirt, held the dirt. One held the dirt for 12 years, one held the dirt for 20 years. In both cases, they ended up selling the dirt, doing 1031 exchanges. In both cases, they got audited, and in both cases, they were disqualified because their intent was to buy, build, and sell. So even a 12 and a 20-year holding period didn't help them qualify for 1031 exchange treatment because their intent was not to hold for investment. Now, if something had changed along the way there, maybe their business model, their business plan, the real estate market, what have you, something changed, and they decided, you know what, let's not build on this. Let's hold it for appreciation, capital growth, and then sell later. And if they had changed the way they reported that on their tax returns, their financial statements, their loan applications, et cetera, emails between advisors, then it would have qualified for 1031 exchange treatment. So Mark's comment about timing is right on the money. You know, those 12 months and a day to 18 months, 24 months, those are opinions, but the way people give the opinion, it sounds like fact.
And talking about opinions, Bill, is that we get a lot of questions as well, is that if I sell a condo, do I have to buy a condo? Actually, no, you don't. As long as the property, the real estate qualifies as a like-kind property and it has met the requirements. So it can be foreign to foreign, or it can be domestic domestic. It cannot be from domestic to foreign, unfortunately. And there are types of like-kind properties. You can mix and match between them. And as I said, as long as it meets the requirements, is that you can exchange into single or multi-family residential, commercial, building, offices, retail shopping centers, vacant lands, oil and gas, pitching if I have forgotten any.
All the weird stuff.
Oh, yes.
Mineral rights, water rights, and air rights.
And even there you can do as an ownership as well, which is a tenant in common and Delaware statutory trust. And there's another type which we call in the exchange world is called a non-like-kind properties. You cannot do a 1031 exchange with it. And there are up to 4 bullet points, and the most important is your primary residence, your vacation home, your second home, and any. Did I forget one?
Nope, just anything with excessive personal use. Yeah.
Yes.
And although that's a good point, because it all goes back to intent, which we talked about, but intent can change. So as Hiba was mentioning, primary residence and second homes don't qualify because it's personal use, but you can stop using it for personal use, change it to investment property, and then it could qualify. So going back to the developer example, if they had stopped treating it as held for development, they treated it as held for investment, it would have qualified. Right. In the examples Hiba just gave, if you stop using it for personal use and you start renting it out, it could qualify for 1031 exchange treatment. So intent can change. You just have to plan ahead, document it well. It's all about what you can document in the event that you get audited. And that's really the key. And to take that a little further, this gets a little complicated, but to take the non-like-kind property further, many of you probably own real estate in some type of an entity, whether it be a C corporation, an S corporation, a partnership, a limited partnership, or an LLC with multiple members. Those type of entities are not disregarded. They're separate, distinct taxpayers. And so the key there is you as individuals have to remember that you don't own real estate. You own shares of stock in a corporation. You own a partnership interest in the partnership. You own a membership interest in the LLC, which is not considered ownership of real estate. And the entity itself actually owns the real property. And so when the property is sold, we have to look at who is the real taxpayer. In those examples, the entity is the taxpayer. Now, if the entity is going to stay together and do an exchange as an entity, that's easy. But in a lot of cases, when you go to sell real estate, you break up and all the investors want to go different directions. And that's where it gets really challenging because individually, you're not selling real property. You're just receiving a cash distribution from the sale. So there are ways to fix that. So I guess the big message there, and we'll go into deeper on this in future podcasts, but the big message here is if you own title to real estate in some type of an entity, Now's the time to ask the question, what is your exit strategy going to be? And that may change, but today, what is your exit strategy going to be? What do you think it is? And then from there, you can, if you want to call us, talk to your attorney, talk to your CPA, and kind of go through, okay, here's my guess as to what my exit strategy will be. Am I holding title the best way possible to take advantage of whatever that exit strategy is? If it's a 1031 exchange and everyone's going to go different directions, maybe now is the time we need to make some changes in how the real estate is owned. So there's lots of options there. It depends on what your exit strategy is. So that's really the key in going down that path. So from that, we're going to wrap up that part of our 1031 exchange today. We're going to carry on with part 2 on our next podcast. So I want to kind of give you an example here of a taxpayer and kind of what you see as a really common example. So we have a taxpayer who owns a single family residence as an individual. She has decided that she really likes owning real estate. So there are those who love tenants and there are those who don't love tenants. And in this case, she loves tenants. And she wants to build her rental property business. So with that, she's decided, I'm going to sell the home, the single family residence that I have, and I'm going to buy a fourplex. So we're really going from a 1-unit to a 4-unit investment property. And she wants to take title to that fourplex in a limited liability company, an LLC. And her intent there is to rent 3 of the units out and to live in 1 of the units. So we're going to buy a fourplex, have 3 rentals and 1 primary residence. She intends to sell that for $500,000 is the estimated value today, and she's got an outstanding loan balance of $300,000. Now she meets with her CPA. By the way, you should always have your team of experts. So, you know, your real estate agent, your closing agent, your CPA, and your attorney, who all really know real estate. So you meet with your CPA to find out what's going to happen if I sell this house and then reinvest in a fourplex. That's when the CPA is going to tell you, well, 1, you've got a huge tax bill coming. So in this case, she meets with her CPA, learns about the 1031 exchange. The questions are that, at least the ones that come up initially, are how much does she have to reinvest? What does she have to buy in terms of replacement property value to defer all of her taxes? With all of the closing costs through the sale and then the purchase, so the routine selling and purchase expenses, the lender-related charges, the operating expenses, which of those costs are permissible and which of those costs are non-permissible? So those are questions that the CPA can help her address. Can she live in 1 of the units? Does that create any problems? Does the single member LLC cause any issues with the ownership of real property? Can she buy the property with somebody else? So there's 2 people who acquired the fourplex. So these are all really good questions, and we're going to answer these questions on our next podcast that goes into Unraveling the Mystery of 1031 Exchanges, Part 2. So from there, we're going to go into Go Ahead and Ask mailbag. And this is where you can email us questions. You can email the questions to ask@exetercode.com. And then we'll address those on the next podcast. So you just tune in and you'll hear your question read over the podcast, and we'll go ahead and answer those questions. The first question I got was from Dave in Orange County, and he was concerned about a 1031 exchange and the deadlines involved, which we'll also talk about on the next podcast. And his concern is with all of the issues involved today, the fast-paced market, multiple offers, bidding wars, things like that, and COVID-19, so you're not always comfortable going out and looking at the properties. You know, how can we address that issue? So Dave, there's a couple of things we can look at there. Number 1, we talked about the reverse 1031 exchange. So that's certainly an option. You can go out and take all the time you want to look for property, find the right properties that make sense, do your own due diligence, go under contract, go into escrow, and close on the purchase. So you've actually bought first, you know you've got the property locked up because you've actually closed on it. That takes the risk out of the 1031 exchange. And we did talk about the fact those are more complicated, there's more costs involved, but that's one way to do it. There's other methods too, such as you might go out and look for property, and if you find property you like, perhaps the seller of that property is willing to go under contract and give you a long-term close. Maybe the seller is willing to grant you 1 or 2 or 3 30-day options to extend the closing. So those are things to consider. Perhaps the seller is willing to lease the property to you with an option to buy the property. So you can tie up the property either through the reverse exchange, through a long-term closing or options to extend, or through a lease arrangement, so that you have more control over when you close on that purchase. The opposite is also true. You can do that on the sales side. So when you're trying to sell your property, today is a seller's market. So you're in the driver's seat. You might be able to get the buyer to go into contract and again have a long-term close, options to extend, etc. So that buys you more time to find whatever your replacement property is that might work for you. So that's something to look at there. It's just a matter of looking outside the box, getting creative with those type of transactions. And that's the only email question I had emailed in. Did anybody else have questions that were emailed to you guys?
People ask me all the time about the COVID-19 extensions. Is there anything else coming down the road? We had the one extension already. We've been trying to explain that, where they came up with that. But if you want to, speak to that a little bit about, do we think we might have any additional extensions from the IRS?
Good question. In fact, the extensions we did get were odd. In this case, what happened is if you were affected by COVID-19, and the answer is yes, everybody was affected by COVID-19, then your deadline was extended to July 15th. So if your 45th day landed on or between April 1st and July 15th, then it was extended to July 15th. If your deadline was April 10th, you got a really nice extension. If your deadline was July 5th, you got a 5-day extension, which doesn't help a whole lot. So it's really kind of odd because that's not what they usually do for 1031 exchanges. A perfect example of what they usually do is add 120 days to your deadline. So for example, we just got a ruling from last week from the IRS where there was some storm victims in Iowa. We have California fires here in California. And of course, they haven't ruled yet, but we anticipate it. We have a hurricane that kind of hit the Texas and Louisiana area. So with those, what they do is say, if you are an affected taxpayer, you get to add 120 days to your 45th day deadline, and you get to add 120 days to your 180th day deadline if that falls within that disaster period. So you have to talk to your accountant and see if you qualify as an affected taxpayer. Usually that means that you are either living in the disaster area, one of the properties in the exchange is in the disaster area, or your accounting records are in the disaster area. So if you do, then you get those deadlines. Going back to COVID, we haven't heard any other rumblings or rumors at this point in time. So we don't anticipate any further extensions. So for COVID-19, we're past the extensions we did receive, and I think that's probably where it's going to end. I don't think we're going to see any further extensions granted.
Good.
Any other questions that got emailed in at all? If not, again, go ahead and email your questions for our next podcast. It's ask@exeterco.com. We'll read those off and get those questions answered for you. So thank you so much for listening to Go Ahead Ask podcast today. And join us next time in 2 weeks for part 2 of Unraveling the Mystery of 1031 Exchanges.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.